Buying them requires nerves of steel but could pay off handsomely. Investors seeking high-return, aggressive growth stocks should check out this list. NVIDIA. It continues to prove its doubters wrong. Mercado Libre. Latin America's e-commerce leader is growing by leaps and bounds. Farfetch. The online luxury goods platform could grow rapidly. Let's dive in. Here are the 3 most aggressive growth stocks to buy in June. Welcome to Timely Investment Research. After a brutal 2022, Wall Street has fallen back in love with high-return, aggressive growth stocks. Stocks with aggressive growth potential have outperformed value stocks by a wide margin so far in 2023, and there's reason to believe this trend will continue. A major force behind the exodus from growth stocks last year was the Federal Reserve's monetary tightening campaign in an effort to bring inflation under control. Currently, we're seeing signs that inflation is cooling and that central bankers are ready to pause interest rate hikes at their June meeting. While there is speculation the Fed may resume raising rates later this year, a clear interest rate ceiling would be a huge upside catalyst for growth stocks. Of course, anyone looking for the top growth stocks to buy must be aware of the risk that comes with them. 2 of the names here have already made huge runs this year. But with a little help from the market and the Fed, I expect all 3 names here to continue to rally. Number 1, NVIDIA. NVIDIA is one of the best performing stocks of 2023, with shares up nearly 170% year-to-date and a market cap that is approaching $1 trillion. The advanced chipmaker has ridden the tidal wave of investor enthusiasms surrounding artificial intelligence higher this year. In fact, investors have bid shares up so high, they currently trade with a price-earnings ratio of more than 200, up from around 6.0 at the start of the year. It takes confidence and an aggressive growth mindset to buy shares with such a sky-high valuation. Investors who plant a flag in the ground now are saying they believe NVIDIA has entered a new era of potentially unbridled growth and that those who don't buy in at these prices will regret it later. NVIDIA's latest quarterly results, released on May 24th, are reason for optimism. The company blew through analyst estimates, reporting $7.19 billion in revenue, down 13% year-over-year, but up 19% from the previous quarter. Analysts had been expecting $6.52 billion. Adjusted earnings per share of $1.09 easily beat the consensus estimate of 92 cents. Furthermore, management delivered better than expected guidance for the current quarter, calling for $11 billion in sales as the company continues to capitalize on the AI revolution. For the full year, analysts are forecasting a 58% jump in revenue and a 132% surge in earnings. In the realm of stocks with aggressive growth potential, it perhaps does not get more aggressive than NVIDIA. With a beta of 1.77 and shares trading near their all-time high, all but the most risk-tolerant growth investors should probably take a pass. Number 2, Mercado Libre. Mercado Libre is the leading e-commerce platform in Latin America, which is a leading region for e-commerce growth. That's a mighty fine position to be in. Rising internet penetration is leading to more online buying, with Statista forecasting Latin American retail e-commerce sales will hit $160 billion in 2025, up from $104 billion last year, for a compound annual growth rate of more than 15%. Investors seem to understand the promise of Mercado Libre, with shares rallying 50% year-to-date. Yet, even with the dramatic run-up in shares over the past few months, the majority of analysts covering the stock still rate it a buy, with a median target of $1,587.50. That's roughly 25% above the current price. In the company's latest quarterly report, first quarter earnings of $3.97 per share beat the consensus estimate by $1.23, while revenue of $3.04 billion came in nearly $151 million ahead of estimates. Revenue was up 58.4% year-over-year, excluding currency fluctuations, while net income of $201 million more than tripled from a year ago, and total payment volume surged 96.1%. Finally, Mercado Libre ended the quarter with 101 million unique active users, up nearly 25% from 81 million a year earlier. Investors looking for the top growth stocks to buy should consider Mercado Libre. With a 3-year revenue growth rate of 63.3% and a 3-year earnings before interest, taxes, depreciation, and amortization growth rate of 254.8%, no one should be questioning the stock's categorization. Number 3. Farfetch. Farfetch operates an online platform that connects buyers and sellers of luxury goods. Unlike the other top growth stocks to buy on today's list, Farfetch's potential has little to do with its fundamentals and everything to do with the promise of the sector in which it operates. The luxury goods market is expected to grow at a compound annual rate of 5.4% through 2030, hitting $369.8 billion. According to Research and Markets, this growth is being driven in part by millennials and younger generations, the influence of social media, and improving supply chains. Farfetch shares are up less than 7% year to date, underperforming the S&P 500. However, considering the fact that luxury goods conglomerate LVMH Moet Hennessy Louis Vuitton is the 13th most valuable company on the planet, I'd say it's worth checking out some of the smaller luxury fashion stocks like Farfetch. In the first quarter, revenue increased 8% year over year, which certainly isn't eye-popping, but cash flows are improving. And Farfetch now hosts more than 1,400 brands on its platform, making it a one-stop shop to access global luxury brand goods. Investors may want to consider taking a small position now in what could become a leading global platform for the fashion industry. Thanks for spending some time with us today, Timely Investment Research. We're so glad you did. If you found value in today's video, please give us a like, hit that bell icon to never miss an upload, and hey, don't forget to subscribe.